If the company we're looking at today were, say, a country, and the assets it manages were its GDP, it would literally be the third most powerful nation on Earth.
Oh, wow. Yeah, that really puts it in perspective.
Right. Sitting right behind the US and China. But significantly larger than the entire economies of Japan or Germany or India.
That's just massive.
We are talking about $13.9 trillion. Trillion with a T.
Yeah.
And in just the first 3 months of this year, another $130 billion in net new money just walked through the doors.
It's a scale that almost defies human comprehension,
Completely.
When a single entity manages nearly $14 trillion, you really have to stop looking at them as just another participant in the financial markets. They're the infrastructure of the market itself.
Yeah, exactly. So welcome to this deep dive. Today, our mission for you, the listener, is to really decode the massive scale and the rapidly shifting strategies of the world's largest asset manager.
It's a fascinating one today.
It really is. We have a stack of sources in front of us, specifically BlackRock's Q1 2026 earnings release and their earnings supplement.
Right, the raw data.
Yeah, and we're going to figure out how a financial behemoth of this size actually makes its money. Because as we dive into these documents, it becomes very clear that their business model is incredibly complex.
Oh, absolutely.
It's no longer just about throwing a bunch of stocks and bonds into a passive index fund and calling it a day. Okay, let's unpack this. What's the real story here?
Well, the overarching theme across these sources is something their CEO, Larry Fink, actually noted in the release. He said, capital is in motion.
Capital is in motion.
Yeah. Analyzing BlackRock's earnings isn't just a corporate review anymore, because they touch every single corner of the global economy. Watching how their clients move billions of dollars gives us a real-time read on the world.
Like shifting out of cash or something?
Exactly. Shifting out of cash or pulling away from broad index funds to buy precision ETFs or even, locking money up in private credit. It shows us exactly what institutional investors believe is about to happen next.
So let's start with the raw financial results from Q1 2026, because honestly, the numbers are just staggering across the board.
They really had a blockbuster quarter.
Yeah, revenue jumped 27% year over year to $6.7 billion for the quarter.
Just massive growth.
And their adjusted operating income increased 31% to $2.67 billion.
Right.
For the shareholders out there, adjusted earnings per share hit 12.53, which is an 11% increase.
Yes, they bumped up the dividends, right?
They did, yeah. They bumped the quarterly cash dividend by 10% to 5.73 per share, and they spent another $450 million buying back their own stock.
Which shareholders obviously love.
Of course. But I want to look at the margins, because the report notes their adjusted operating margin expanded by over 100 basis points. It landed at 44.5%.
That's a huge number.
It is. And for anyone who doesn't speak Wall Street, a basis point is simply 1/100%.
Right.
So 100 basis point expansion means BlackRock is keeping an entire extra percent of their revenue as pure operating profit compared to last year.
Yeah, keeping almost 45 cents on every dollar that comes in is just wild for a business operating at a multi-trillion-dollar scale.
How do they even manage that?
Well, that 44.5% margin is a textbook example of operating leverage.
Okay, meaning what exactly?
Meaning, once you build the technological infrastructure to manage $10 trillion, managing the 11th, 12th, and 13th trillion doesn't actually cost you that much more in terms of overhead.
Ah, I see.
Yeah, the servers are already running, the software is built, the portfolio managers are already at their desks.
So the fixed costs are covered.
Exactly. Every new dollar that flows in falls much more directly to the bottom line.
That brings up a critical question, though. The S&P 500 was up roughly 16% over the 12 months leading up to this Q1 2026 report.
It was a great year for the market.
Right. So if the broader stock market is doing that well, isn't an asset manager's massive growth just, a mirage?
How so?
I mean, if I manage your portfolio and the market goes up, my total assets under management go up automatically, right? And my fees go up.
Sure.
But I didn't actually do anything to earn that. I'm just riding the coattails of a rising market.
That's a really fair point. In the industry, that passive lift you're describing is called market beta.
Market beta. Okay.
Yeah, it's the rising tide that lifts all boats.
Yeah.
And analysts are always trying to strip away that market beta to see if an asset manager is actually growing or, just getting lucky with a bull market.
So how do we strip it away? What's the metric?
The metric that reveals the truth is organic inflows.
Okay.
This measures net new money. Are our clients actually taking fresh capital out of their bank accounts? or taking it away from a competitor and handing it to BlackRock to manage?
And the sources show that the answer is overwhelmingly yes.
Very much so.
Over the last 12 months, ending in March 2026, BlackRock pulled in $744 billion in net inflows.
Which is just a staggering amount of capital.
Right. That is entirely separate from the market going up. That is hundreds of billions of new dollars walking through the front door.
Exactly.
Oh,
And
yeah.
the ripple effect of that new money is what really drives the stock price. Like, the earnings supplement shows a 10% organic base fee growth for the quarter.
Wow, 10%.
It's a massive metric. It represents the highest first quarter organic base fee growth BlackRock has seen in 5 years.
So they're taking market share.
Precisely. They aren't just holding on to assets that are appreciating. They are aggressively capturing a larger share of the global market's fresh capital.
I want to trace exactly where that fresh capital is going because there is a massive discrepancy hidden in these inflows.
Oh, the ETF versus institutional numbers?
Yes. Let's look at exchange-traded funds, or ETFs. BlackRock's ETF brand is called iShares, and it just posted a record first quarter with $132 billion in net inflows.
A record quarter.
Yeah, and the net new base fees they collected from those ETFs literally doubled compared to the same quarter last year.
What?
But here's where it gets really interesting. At the exact same time they pulled in $132 billion in ETFs, their institutional indexing division saw $35 billion in outflows.
Yeah, a huge outflow.
People pulled $35 billion out. Cash management also bled $6 billion.
Right.
Why would a massive pension fund or sovereign wealth fund pull billions out of a traditional institutional index fund only to turn around and pour billions into ETFs? I mean, aren't they essentially the exact same thing?
Well, they are both largely passive vehicles, yes. But the underlying mechanics of how they trade and what they target are fundamentally different.
Okay, walk me through that.
This is a massive behavioral shift in professional finance right now. Historically, traditional institutional index funds and mutual funds settle just once a day.
Right, at the close.
Exactly. You
Yeah.
put your order in and you get whatever the price is at the closing bell. ETFs, on the other hand, trade intraday,
Like a stock.
just like a normal stock. You can buy and sell them at 10:14 a.m. or 2:42 p.m.
So it's about liquidity. The institutions want the ability to pivot immediately if, say, the Federal Reserve makes a surprise announcement at 2 in the afternoon.
Yes, liquidity is half the equation. But the other half is what BlackRock's report refers to as precision exposures.
Precision exposure.
Yes, yeah.
20 years ago, if an institution wanted to invest passively, they just bought a fund that tracked the entire S&P 500 or the total bond market.
They bought the whole haystack.
Exactly, the whole haystack. But today, because the ETF market has become so hyper-segmented, institutions can buy very specific slices of the market.
Oh, I see.
Let's say a macro fund manager believes Japanese semiconductor companies are going to outperform, but they don't want the risk of picking individual stocks.
Right.
They can just buy a highly targeted ETF that only holds Japanese tech stocks.
Ah, okay. So they are taking their money out of the broad, sleepy, whole market index funds, which totally explains the $35 billion outflow.
And they are using precision ETFs as surgical tools to tilt their portfolios. They are essentially using passive instruments to execute highly active, opinionated trading strategies.
That is precisely what is happening. The boundary between active and passive investing is completely blurring.
It really is.
And we see that blurring happening within BlackRock's active management division as well.
How so?
Well, we usually think of BlackRock as the undisputed king of passive index tracking, right?
Sure.
But the sources show their active equity division, where human managers and quantitative algorithms are actively picking individual stocks to beat the market, actually saw $3 billion in net inflows this quarter.
Beating the market, the industry term for that is generating alpha, right?
Yes, alpha is the return you get above and beyond the benchmark index.
Okay.
For years, the narrative was that active management was dead and everyone was moving to passive low-cost indexes.
That's all you'd hear.
But the data here proves that clients are willing to pay higher fees if they believe a manager can actually deliver alpha.
They want that outperformance.
Exactly, particularly in volatile markets or international sectors where a smart manager can still find mispriced stocks.
Well, if clients are suddenly willing to pay higher fees for outperformance, that brings us to the most radical shift in BlackRock's entire strategy.
The pivot to private markets.
Yes. We are moving from the high-volume, fraction of a percent fee world of public ETFs straight into the incredibly lucrative world of private markets.
A whole different ballgame.
The earnings supplement shows private markets saw $9 billion in net inflows in Q1. Total private markets assets under management now sit at over $320 billion.
Which sounds small compared to 13.9 trillion, but
The fee structure is mind-bending. Total performance fees for BlackRock skyrocketed 353% year over year, hitting $272 million.
and look at where that came from.
Right, out of that total, $232 million came exclusively from private markets.
If we connect this to the bigger picture, this is the economic engine that Wall Street is fixated on right now.
Tell me more about that.
In the ETF world, you charge a tiny base fee, maybe 3 basis points, or 0.03%, and you make your profit purely on unimaginable scale.
Right, high volume, low margin.
Exactly. But private markets operate on an entirely different plane. These are investments in things you can't just buy on the New York Stock Exchange.
Like what?
We're talking about direct lending to mid-sized corporations, or buying a stake in a physical airport, or funding a massive green energy infrastructure project.
And because those investments are illiquid, meaning you can't just sell your airport stake at 2 p.m. on a Tuesday, the managers can charge a premium.
Oh, a massive premium. They charge a much higher base fee, often between 1% and 2%, simply to manage the money.
Wow.
But the real windfall is the performance fee.
Right. How does that work?
If a private equity or private credit fund clears a certain return hurdle, say an 8% annual return, the manager takes a massive cut of all the profits above that hurdle, often 20%.
20% of the profits. That's huge.
Yeah, that is how a relatively small slice of BlackRock's total assets, just $320 billion out of $13.9 trillion, is generating hundreds of millions of dollars in performance fees in a single quarter.
So BlackRock is essentially acting like a luxury boutique for the ultra-wealthy on one side of the store, while running a massive discount warehouse for ETFs on the other.
That's a great way to put it, yeah.
But BlackRock didn't grow up in the private markets. For decades, they were the ultimate discount warehouse for public equities and bonds.
Right.
You don't just wake up one morning and suddenly become a bespoke luxury boutique for private credit investors.
Oh, you don't build it from scratch. You buy the boutique and put your name on the door.
Which explains the massive acquisition spree we see detailed in these sources.
Exactly. Over the last 2 years, they've been aggressively buying their way into the private markets.
Let's run through them. They acquired Global Infrastructure Partners, or GIP, in October 2024.
Right.
Then they bought HPS Investment Partners in July 2025. Then they added Elm Tree in September 2025.
It's been nonstop.
Let's look specifically at the HPS deal, because the immediate financial impact is wild.
HPS is a heavyweight in private credit.
And just in this first quarter of 2026, HPS brought in $230 million in base fees alone.
That's just base fees. Private credit is arguably the most important structural shift in finance over the last decade.
Why is that? What caused it?
Well, following the 2008 financial crisis, regulators forced traditional banks to hold much more capital in reserve.
Oh, okay. To make them safer.
Right. But that made it incredibly expensive for them to issue loans to mid-sized companies. So the banks stepped back.
But those companies still needed capital.
Exactly. To build factories, hire workers, expand. So private credit firms like HPS stepped into the void.
So they became the new lenders.
Yeah. They essentially act as shadow banks, raising money directly from pension funds and insurance companies and lending it directly to corporations at high interest rates.
So by acquiring HPS, BlackRock didn't have to spend a decade slowly building relationships with corporate borrowers.
Not at all.
They instantly bolted a fully functioning, highly profitable corporate lending machine onto their existing global distribution network.
And that distribution network is the key here. BlackRock already manages the money for the world's largest sovereign wealth funds and pensions.
Right.
Before the acquisition, if a client asked BlackRock for private credit exposure, BlackRock might have had to turn them away or offer a lesser internal product.
But now
they can immediately route those billions of dollars straight into HPS funds, capturing those high base fees and massive performance fees totally internally.
But managing this entire ecosystem sounds like a logistical nightmare. I mean, think about what we've covered so far.
There's a lot of moving parts.
On one side of the company, they are managing millions of individual retail accounts, trading precision ETFs by the second.
Yeah.
On the other side, they have teams negotiating 5-year, illiquid, billion-dollar private credit loans to construction conglomerates.
Right.
And they are actively integrating multiple massive acquisitions like GIP and HPS all at the exact same time.
It's crazy when you think about it.
How do you even calculate the firm's total risk exposure at any given second? How does the whole thing not just collapse under the weight of its own complexity?
Well, it would collapse if they were relying on human beings with spreadsheets.
Fair point.
The only way to manage a $13.9 trillion multi-asset portfolio is to possess a technological backend that is arguably more sophisticated than the financial products themselves.
And that brings us to the hidden engine inside this asset manager. BlackRock is, in many ways, a massive software company.
It really is.
Looking at the Q1 numbers, their technology services and subscription revenue grew 22% year over year.
22%.
They generated $530 million in a single quarter just from selling software and technology services.
That's a huge business on its own.
And their annual contract value, or ACV, grew by 14%. The sources attribute this growth to their proprietary software platform, Aladdin, and a brand new acquisition called Preqin, which they bought in March 2025. Preqin alone contributed about $65 million to Q1 revenue. So what does this all mean? Are they basically selling the shovels during the gold rush?
Let's talk about ACV, because that is the metric that makes Wall Street analysts sit up and pay attention.
Okay, annual contract value.
Yes. It measures the forward-looking, annualized revenue from recurring software subscriptions. Wall Street will always assign a decent valuation to an asset manager, but they will assign an astronomically high valuation to a SaaS business.
Software as a service.
Exactly.
Because asset management fees can drop instantly if the stock market crashes, right? But software subscription fees are essentially locked in.
Correct. Software revenue is incredibly sticky.
And Aladdin is the core of that.
Yeah, Aladdin is BlackRock's risk management and portfolio operating system. They built it internally to manage their own risk, but years ago they realized other institutions desperately needed it too.
So they started leasing it out.
Yep. If you are a rival bank or a massive insurance company, and you spend 2 years migrating all of your trading systems, compliance checks, and risk models onto the Aladdin platform, you are not going to unplug it just because the stock market had a bad month.
No, it's too embedded.
You rely on it to function. Aladdin is essentially the central nervous system for thousands of global investment firms.
Okay, so if Aladdin is the central nervous system, how does the new acquisition, Preqin, fit into the biology of this machine?
That's a great question. Preqin acts as the sensory organs for a part of the market that was previously totally numb, the private markets.
Oh, interesting.
We talked about how lucrative private equity, private credit, and infrastructure are. But the major flaw with private markets is that they are notoriously opaque.
Right, because private companies don't have public stock tickers updating their price every millisecond.
Exactly.
How do you actually know what a privately owned toll road in Ohio or a mid-sized software developer in Texas is truly worth on a given Tuesday?
Well, you don't have a live ticker, so you have to rely on comparables and historical data. Preqin is one of the premier providers of data and analytics on the alternative investment space.
I see.
They track the performance, fundraising, and valuations of private funds globally.
So look at the sequence of moves BlackRock made.
Okay.
They bought the private market managers, like GIP and HPS.
Right.
Then they bought Preqin, the company that provides the data on how to value those private assets.
Got it.
Then they integrate Preqin's data directly into Aladdin.
Wow. I see the strategy now. BlackRock isn't just investing the money. They own the private funds, they own the proprietary data used to value those funds, and they own the risk management software that their competitors rely on to analyze that data.
It creates a closed-loop ecosystem.
Yeah.
Whether a competitor chooses to invest in a BlackRock ETF or buy into a BlackRock private credit fund, or strictly buy their own investments entirely separately, that competitor is almost certainly paying BlackRock a subscription fee to use Aladdin to calculate the risk of their portfolio. They win no matter what.
They're woven into the fabric of the trade, regardless of who is making it.
And speaking of the behind-the-scenes financial maneuvering, there is a fascinating detail buried in the expense report that perfectly illustrates how companies at this scale manage their balance sheets.
Oh, the charitable donation.
Yes. Their general and administrative expenses actually dropped by $140 million sequentially from the fourth quarter of 2025 to this first quarter of 2026.
Which is unusual.
Usually in a growing company, expenses just steadily creep up quarter after quarter. But the sources reveal this drop happened because in Q4 of 2025, BlackRock made a unique, one-time $109 million charitable contribution.
And they didn't just write a check.
No, they didn't. They donated stock they held in the Circle Internet Group.
That detail is a brilliant look at corporate financial engineering.
Break that down for us.
By donating appreciated stock instead of cash, a corporation accomplishes multiple things at once. First, they remove a volatile asset from their balance sheet. Second, they get a tax deduction based on the fair market value of the stock at the time of the donation.
Smart.
And third, it creates a massive one-time expense spike in Q4. Once that anomaly passes, the subsequent quarter Q1 2026 shows a sequential drop in expenses, making the current operating margins look even cleaner.
It's just wild. When a $109 million charitable stock transfer is just a routine balance sheet optimization, you truly grasp what managing $13.9 trillion looks like in practice.
It's a completely different level of the game.
So let's pull all of these threads together for you, the listener. If you started this deep dive thinking of BlackRock as just the company that runs your passive S&P 500 index fund, you now know that is only a fraction of the story.
The modern asset manager has to be a master of three distinct pillars.
Let's recap them. First, the public markets, where clients are pulling money out of broad mutual funds and pouring $132 billion into ETFs to execute highly targeted precision trades.
Right.
Second, the private markets, where BlackRock has spent billions acquiring heavyweights like GIP and HPS to capture the massive performance fees generated by illiquid assets like private credit and infrastructure.
Huge growth area.
And third, the technology pillar, where software like Aladdin and data platforms like Preqin generate over $500 million a quarter in sticky, recurring revenue.
Yeah. If you are reviewing your own portfolio or your company's strategic positioning, you have to recognize these tidal forces.
Absolutely.
Capital is actively seeking precision in the public markets and high-yield direct lending in the private markets.
And as we watch BlackRock build the ultimate closed-loop system to capture all of that capital, it introduces a completely new dynamic to global finance. We know that thousands of financial institutions rely on Aladdin to calculate their risk.
Right.
We know Preqin is feeding the valuation data into that system.
This raises an important question, though. If the majority of the global financial system is relying on the exact same software, feeding on the exact same proprietary data to assess the risk of both public stocks and opaque private loans.
Yeah.
What happens if the software makes a mistake?
Oh.
If everyone in the market is using the exact same map to navigate the global economy, does a single algorithmic typo have the power to drive the entire market off a cliff simultaneously?
Wow. We'll leave you to chew on that one. Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking at the underlying data, and we will catch you on the next one.